Today we are going to talk about the balance sheet under the final accounts. Children, when we talk about balance sheet, let us know what does it mean first. Balance sheet means a financial statement which sets out the assets and liabilities of trading or non-trading organizations as on a certain date. Children, it is a statement which reports the property value owned by the enterprise and the claims of the creditors and owners against these properties. It shows the status of the business as at a given moment of time. In so far as accounting figure can show its status. Children, when we talk about balance sheet, to know what is the financial position of business in terms of what is owned by it, that is its assets, and what it owns to the proprietor in the form of capital and to the outsiders in the form of liabilities is shown. So we can say it is a position statement of business or balance sheet is prepared for these reasons. Now when we talk about balance sheet, children, the sum of liabilities and capitals should be equal to the assets. That is, assets is equal to liabilities plus capital. Balance sheet, children, is the final phase in the accounting cycle. Children, the position of assets, liabilities and capital is bound to change with the occurrence of series of business transactions. The trading account and the P&L account do not help in ascertaining the real position of assets, liabilities and capital. When we talk about the trading account, children, the trading account discloses either gross profit or gross loss. While when we talk about the profit and loss account, children, it discloses the net profit or net loss. So, to know what is the financial position of the business in terms of what is owned by it, that is its assets, and what it owes to the proprietor in the form of capital and to the outsiders in the form of liability, a position statement needs to be made. That is, a balance sheet needs to be prepared. A balance sheet, children, is prepared at a particular point of time. It simply means that balance sheet discloses the assets owned by the business, kindly note, and the total claim of outsiders and owners against these assets at a particular point of time. The sum of liabilities, children, and capital should be equal to the assets. Children, the difference between assets and liabilities is capital, that is proprietor's claim. If, kindly note, the assets are more than the liabilities, the business is said to be solvent. I repeat, if the assets are more than the liabilities, then the business is said to be solvent. On the contrary, if the liabilities, that is amount payable to the outsiders, is more than the assets, the business is said to be insolvent. It simply means assets are insufficient to pay outside liabilities and nothing is left for the proprietor. The balance sheet, children, kindly note, or position statement is based on the fundamental accounting equation. That is, assets is equal to liabilities plus capital. That is why this equation is also called as the balance sheet equation. Now children, when we talk about balance sheet, it is a mirror which reflects the true position of the assets and liabilities of business on a particular day. Children, now let us talk about the characteristics of balance sheet. The first characteristic of balance sheet is statement. Let us know what do we mean by it. Children, balance sheet is a statement of balances of those accounts which have not been closed. It is not a ledger account. Kindly note, it is not a ledger account. Therefore, this statement does not have debit and credit side. Instead of debit and credit, children, in balance sheet we use the assets and liabilities. To and by words are not used in balance sheet. Number 2, static. Balance sheet, children, is a static document. How? Because, children, it is prepared on a particular date. It shows the financial position of business on a particular date. Number 3, assets and liabilities. Balance sheet, children, shows all the assets on one side and liabilities and capital on the other side. All debit balances in the real account and personal account are recorded on the asset sides. Kindly note, I repeat, all the debit balances in the real account and personal accounts are recorded on the asset sides, while all the credit balances, children, are shown on the liability side, with an exception of the provision for doubtful debts and provision for discount on debtors. Knowledge of financial position. Yes, children, balance sheet shows the financial position of the business. One can be ascertain the solvency, liquidity, financial soundness of the business with the help of balance sheet data. Children, when we talk about balance sheet is prepared to show the financial position of business, as we discussed earlier also. Now, it is very important to know that what is marshalling of balance sheet. Children, the exact form of balance sheet depends upon the order in which the assets and liabilities are arranged. This arrangement of assets and liabilities in the balance sheet is called as marshalling of balance sheet. Children, these assets and liabilities can be arranged in the balance sheet in two ways, that is liquidity preferences and the permanence preference. Children, now let us talk about first of all the liquidity preference. Children, liquidity means the readiness with which the assets can be converted into cash. The shorter this time taken to convert the assets into cash, the greater is the liquidity. Under the liquidity, children, method, the most liquid or the current assets such as cash, debtors, stock are listed on the top. The less liquid assets or fixed assets, kindly note, they are shown after that. That is plant and machinery, land and building, they are listed thereafter the current assets. Fictitious assets, example children, preliminary expenses and unexpired expenses values are shown at the bottom of this kind of balance sheet. Similarly, children, when we talk about the liabilities, in this also current liabilities are shown first and the long-term liabilities and capital are shown the last. This is the case in the liquidity method of balance sheet. Now let us look at it. In this, children, we have liabilities column and the assets column. In the liabilities column, children, we have current liabilities, that is outstanding expenses, incomes received in advance, bills payable, sundry creditors, bank overdraft. It also has, children, the long-term liabilities such as long-term loans, loan on mortgage, debentures, owner's equity, capital, reserves, retained profits, etc. On the assets side, children, kindly look. It has current assets such as cash in hand, cash at bank, bills receivable. With these all are the ones which are current uh, assets which are readily converted into cash. So they would be recorded first. It also has investments, and then it is followed by fixed assets such as furniture, fixtures, plant and machinery, building and goodwill, etc. Followed by the fictitious assets. So children, this was about the liquidity method of recording the assets and liabilities in the balance sheet. Now let us look at the permanence preference method of recording the assets and liabilities in the balance sheet. When we talk about, children, the permanence preference method, kindly look here. This is the specimen of balance sheet according to the permanence preference method. Now children, in this method, the most permanent or fixed assets such as goodwill, land and building, plant and machinery are placed on the top, whereas children, the less permanent nature assets such as furniture, tools and current assets such as stock in hand, sundry debtors, cash are listed thereafter. Fictitious assets and unexpired expenses, children, are shown in this type also at the bottom of the balance sheet. In other words, children, it is just the opposite of the liquidity method. Now when we talk about the liabilities, children, it is permanent liabilities are listed first and then it is followed by the short-term liabilities. Now let us look at this specimen. We have two columns, that is liability and assets along with their amounts. In the liabilities column, children, first thing what we have is the owner's equity, that is capital, reserves, retained, profits, long-term liabilities, debentures, loan on mortgage. Under the current liabilities, children, we have bank overdraft, sundry creditors, income received in advance, outstanding expenses, and then it is followed by the contingent liabilities. Under the assets, children, we have fixed assets such as goodwill, land and building, plant and machinery, furniture and fixtures, motor vehicle. Then it is followed by investments, followed further by current assets such as stock in hand, accrued income, prepaid expenses, sundry debtors, bills receivable, cash at bank, cash in hand. Kindly note, children, the assets and the liabilities side, they should be equal in all kind of balance sheets. Only then we can say that your question is fully solved. There is no error in preparing the trading account, P&L account and balance sheet if all this is balanced out. Now children, let us talk about the classification of assets and liabilities. Children, when we talk about the classification of assets and liabilities, children, proper classification of assets and liabilities is quite necessary. Otherwise, children, balance sheet may fail to provide you meaningful information. The various items of assets and liabilities in the balance sheet should be properly grouped. Now, let us talk about the classification of assets. Children, assets may be divided into number 1 fixed assets, number 2 investments, number 3 current assets and fictitious assets. Now let us talk about each one of them. Fixed assets. Children, they are the assets of permanent nature. They are acquired for the purpose, kindly note, of generating revenue and not meant for any kind of resale. For example, of the fixed assets are land, building, plant and machinery, motor vehicle, furniture, fixtures, patents, goodwill, etc. As the purpose of these assets, children, is use changes in their market value are ignored. That is, these assets are shown in the balance sheet at cost less their depreciation. Now the fixed assets, children, which have a limited useful life, which depreciate rapidly, are called as wasting assets. Example, mines, quarries, etc. Now children, when we talk about goodwill and patents, which cannot be seen, are known as intangible assets. Assets like children, plant and machinery, stock, cash, they all can be seen and felt. Whereas the assets which cannot be seen and felt are called as intangible assets. So, intangible assets are patents, goodwill, etc. Now talking about investments. Children, investments include money invested in various kind of securities. Investments, children, can be of two types. That is long-term investment and short-term investments. Long-term investments, children, they are treated as fixed assets. Whereas children, the short-term investments, they are treated as current assets. Now, let us talk about the current assets. Current assets are the assets which are acquired and held for the consumption or resale in the ordinary course of business. They are converted into cash, children, with short time period. Current assets include, children, cash and bank balance, sundry debtors, short-term loans, closing stock, prepaid expenses, interest receivable on investments and other accrued incomes. These assets, children, are also known as circulating assets because they are into the circulation in the business. Now children, let us talk about fictitious assets. They are not represented by possession of any kind of property. Preliminary expenses, discount on issue of shares and debentures, they are all examples of fictitious assets. Children, they are to be written off against the profit and loss account. Now children, let us talk about the liquid assets. Cash in hand, cash at bank and investments that can be converted into cash quickly are called as the liquid assets. Now children, this was all about assets part. Now let us talk about the classification of liabilities. Liabilities, children, are further classified into fixed liabilities, current liabilities and contingent liabilities. Fixed liabilities, they are the liabilities which are repayable after a long period of time. They are not repayable within a short period and during the operating cycle of business. They include, children, loan or mortgages and debentures. Current liabilities, they are the liabilities, children, which are repayable within a year or in near future. Examples of current liabilities, children, are trade creditors, bills payable, outstanding expenses, bank overdraft. Now let us talk about what do we mean by contingent liabilities. They are anticipated liabilities. That is, they are uncertain and may or may not arise in future. Examples of such liabilities, children, are guarantee for a loan, any kind of disputed claim. They are some of the contingent liabilities. Children, today we have discussed about balance sheet, what are its characteristics, why we need to prepare it, because it tells us the financial position of the business. So children, please go through the video and clear your doubts over the Microsoft Teams. Till then, take care. Thank you. Have a good day.